Why doesn't $1 equal £1 or £1? They're all just money, right? Paper, numbers, digits on a screen. So why can $1 buy something completely different than another currency? It feels random, like someone somewhere just decided the value. But the truth is, currency isn't about the number printed on it. It's about trust and what that money can actually buy. Every currency represents the strength of an entire economy. When a country produces more, grows faster, and attracts global investment, its currency becomes stronger. Demand rises, and when demand rises, value increases. But when an economy slows down, jobs disappear, or too much money gets printed without real growth behind it, confidence drops, and once trust falls, the currency weakens. That's why exchange rates are always changing. Today, $1 might get you around 100 yen. Tomorrow, it could be less or more, because economies are constantly shifting. Trade plays a huge role too. If one country exports more than it imports, its currency becomes more valuable. Why? Because buyers need that currency to pay for goods. So demand increases, and value follows. At the end of the day, currencies compete just like businesses, driven by performance, trust, and global demand. Now here's something even more surprising. Almost every country in the world is in debt. The US, China, Japan, the UK, all owe trillions. So the real question is, who do they owe? The answer is simple: each other and their own people. Governments don't just print money to fund everything. They borrow by issuing bonds. Think of a bond as a promise. You lend money today and get paid back later with interest. These bonds are bought by individuals, banks, retirement funds, and even other countries. So when a country owes trillions, that debt is spread across millions of investors. And here's the key: countries don't usually pay off all their debt. They refinance it. Old debt gets replaced with new debt. As long as trust remains, the system continues. So why not just print more money? Problem solved, right? Not exactly. Money only works if it represents real value. Imagine this. There are 100 people and 100 loaves of bread. Everything is balanced. Now suddenly, more money is printed, but the number of goods stays the same. What happens? Prices rise because more money is chasing the same products. That's inflation. Printing money doesn't create wealth. It spreads value thinner. History has already shown this. In extreme cases, money becomes almost worthless because trust disappears. Now, let's talk about something different. Bitcoin, a form of money that exists only online. No banks, no governments, just code. It runs on something called blockchain, a public system that records every transaction. When you send Bitcoin, thousands of computers verify it. Once confirmed, it becomes permanent. And here's what makes it unique. No one controls it. No one can print more whenever they want. There's a fixed supply. Only 21 million will ever exist. That scarcity is why people compare it to digital gold. But it's not perfect. Prices move fast. Transactions can be slower than traditional systems. And if you lose access, there's no recovery. Still, it proves one thing. Money doesn't always need a central authority. Most people think falling prices are a good thing, but that's not always true. When prices keep dropping, people stop buying. Why spend today if things will be cheaper tomorrow? Spending slows. Businesses lose revenue. Jobs disappear, and the economy begins to freeze. This is deflation, and it can be dangerous because once spending stops, everything else follows. That's why economies aim for slow, steady growth. Movement is what keeps the system alive. Now here's something most people misunderstand. Tariffs. When governments tax imports, it sounds like foreign countries are paying, but they're not. The cost lands on businesses, and eventually, on consumers. Companies pass that cost forward, which means higher prices. Even when tariffs protect local industries, prices rarely go down because competition decreases. So in the end, the buyer pays. Why is buying a home so difficult today? Decades ago, one income was enough. Now even two incomes struggle. Prices have surged, but wages haven't kept up. Supply is limited. Demand keeps rising, and investors have entered the market. Homes are no longer just places to live. They're assets, and that changes everything. There are two ways people approach money in markets: trading and investing. Trading focuses on short-term moves, quick decisions, fast profits, but high risk. Investing is long-term, based on growth over years. Patience matters more than timing. Most traders lose because timing the market is extremely difficult, but investors rely on time and compounding. Two different strategies, two different mindsets. For most people, debt is a burden, but for the wealthy, it's a tool. Instead of selling assets and paying taxes, they borrow against them. This gives them cash without giving up ownership, and often, the return on their investments is higher than the cost of borrowing. That difference builds wealth. Debt isn't always bad. It depends on how it's used. Finally, there's something most people hear about, but rarely understand: money laundering. It's the process of making illegal money appear legal. First, the money enters the system. Then it moves through multiple transactions, making it harder to trace. And eventually, it comes back as clean income. The system works because financial activity is massive. Millions of transactions happen daily. And within that noise, it's possible to hide patterns. So what does all of this mean? Money isn't just paper. It's trust. It's systems. It's behavior. And once you understand how it really works, you start seeing the world differently. Because the biggest advantage today is not just earning money, it's understanding it. If you found this valuable, make sure to subscribe, because the next video will break down how to actually use this knowledge to build real wealth in 2026.